Let us look at one particular method of income splitting in a partnership to which Section 94 cannot apply. Robert is a partner in a law firm who assigns 6/13 of his partnership interest to his wife Hilary. The net effect of this is that Hilary is entitled to receive 6/13 of Robert's share of the profits. However, under the agreement, she is not entitled to any other partnership rights such as management rights or the right to inspect the books. Such an assignment of partnership income was successfully undertaken in the case of FCT and Everett, where the High Court held that this was a legal and valid arrangement that successfully split the transferor's share of the partnership profit. In the later case of FCT and Gallant, a partner on June 27 made a similar assignment of 49% of his partnership interest, not to a human, but to a trust that the transferor both effectively controlled and was a beneficiary of. The High Court held that this was a valid assignment of income and clarified two issues regarding such assignments. Firstly, an assignment undertaken before the end of the financial year can include the income earned for that full financial year, meaning that even though the transfer was undertaken on June 27th, it successfully transferred income for the full income year as well as for the future years. Secondly, the court found that even if the transfer was to an entity to which the transferor had control of or could financially benefit from, as was the case here, it was still a valid transfer. The ATO has stated in Tax Ruling IT 2501 that the general anti-avoidance provisions of Part 4A will not apply to an Everett type of assignment. It did, however, also state that Section 102, a specific anti-avoidance provision, will apply if the transferor or other partner maintain the right to reverse the assignment. Section 102 has the effect of making the transfer ineffective. So, in Everett, if the deed which actioned the transfer stated that the transferor could in future years unilaterally reverse the transfer would never be considered effective. A valid assignment of partnership interest can potentially trigger a CGT liability. Maxine paid $500,000 to buy a partnership, and the partnership share was currently worth $700,000. Maxine then assigned 40% of her partnership rights to her husband for $280,000. If Maxine's interest was acquired prior to 20th September 1985, then no CGT will be payable by her. On the other hand, if it wasn't, then she would be subject to CGT. Maxine's capital proceeds are $280,000. If she instead transferred the amount for no consideration or not at market value, the capital proceeds would be deemed to be the market value, also being 40% of $700,000, which equals $280,000. The cost base would be $200,000, meaning that her capital gain would be $80,000. This would typically be subject to 50% CGT concession and possibly also the small business CGT concessions.